Wouldn't it be great if there was a list of the best technology companies in the world ready to be copied and pasted into your investment portfolio?
Well, there is, and it's called the Nasdaq Composite Index. Microsoft, Apple, Amazon, Facebook, Google, and thousands more. Technology is the future, and giants on the Nasdaq must surely form part of everyone's portfolio.
As we'll show in this video, American technology companies have been outperforming the rest of the market these last 12 years since the 2008 recession, absolutely smashing the S&P 500, our usual go-to American index of choice. For a stock to be listed on the Nasdaq, it needs to meet the strictest of requirements around finances, liquidity, and corporate governance. Only the best companies are allowed.
Adding these monster companies to your portfolio has never been easier. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
This video is sponsored by Stake, an exciting new investment app specialising in US stocks. With over 3,500 US stocks available, there is so much opportunity to be seized upon, including investments in giants like the ones mentioned in this video.
A great way to invest in the US, in our opinion, is via a specialist platform like Stake.
Stake offers unlimited commission-free trading and trades are executed in real time. It is of course FCA regulated and comes with FSCS protection. Plus, Stake offers fractional investing, allowing you to buy any dollar amount of any share. Awesome.
And for a limited time, Stake are giving away a free US stock worth up to $100 when you sign up via our link. We'll put the link to the offers page in the description below, so be sure to check that out. Now, let's get into the video. Why the Nasdaq? The Nasdaq is an American stock exchange heavily allocated towards top performing industries, mainly technology, but with some financial, consumer services and healthcare to round it out. The Nasdaq 100 index tracks 100 of the top non-financial companies on the Nasdaq stock market. These super industries have helped the Nasdaq 100 outperform the S&P 500 by a wide margin between 2007 and 2019. Covering the period of the last recession.
The total return of these two major American indices, which include dividends and reinvesting all gains, is 315% for the Nasdaq 100 versus 156% for the S&P 500. Those are annualized returns of 13% for the Nasdaq 100 against 9% for the S&P 500. In fairness, 9% is still amazing and shows how great the US has been overall for investors since the last recession and why we still love the S&P 500 index.
Future outlook. Given the various ways in which technology is influencing the world and making companies more efficient, we can only see this trend continuing into the future. We look around at how businesses adapted globally during lockdowns in the 2020 corona crisis and see the services these tech companies offer being more vital than ever.
When businesses realise that their staff work remotely for months without any issues, we predict that remote working will become much more widespread. Why wouldn't companies choose to get rid of their expensive rent payments on city office buildings if they could?
During lockdown, we saw Amazon become an essential service. Providing computers for staff to work from home has meant companies invest in more Microsoft, Cisco, Intel, Adobe and Google products. PayPal and other online payment services will be way more in demand in a world where people do everything remotely. And do we really need to mention why Netflix makes more money when people work from home?
Why the Nasdaq was created. The Nasdaq was created to be the world's first electronic stock market. In itself, a world-changing innovation which removed the need to be trading manually on a trading floor. Now, trading can be done online with records in the cloud, and the Nasdaq sold its capabilities to other exchanges around the world so they too could go online.
It is what led to you and us being able to buy stocks online, even on our phones. And it is no wonder that the tech companies of Silicon Valley all wanted to list themselves on this index. Which is handy, because all the tech companies that we'd want to invest in are all listed together on the same index. So, how can we invest in them?
Fractional trading. Many of these companies have been so successful that over the years their stock prices have grown to ridiculous highs. These stocks would have needed a stock split for ordinary people to be able to afford to trade them. Look at Amazon. One share cost $2,400 at time of filming. Alphabet, Google's parent company, cost $1,200.
For you beginner investors out there, this means exactly what it sounds like. You have to part with $2,400 cash to be able to buy the smallest unit of Amazon stock. This is outside the reach of most beginners. That is, until all that changed. Fractional investing is now available on many investing platforms, including the stake platform mentioned earlier, meaning you can buy parts of shares. It's a fantastic innovation. If you want to buy just a few quid of any of those Nasdaq companies, you now can. You are in charge of your own portfolio.
Nasdaq ETF. An alternative way to invest in the Nasdaq is using an ETF. So you can invest in all the top Nasdaq companies at once with a single investment. The one we'd use as UK-based investors is the iShares Nasdaq 100 ETF, listed on the London Stock Exchange and priced in pound sterling, which has an OCF of 0.33%. It's a more expensive way to invest in America than the S&P 500 ETF, which costs just 0.07% with some providers, but what we're getting here is a weighting in favour of technology companies.
It invests in the top 100 non-financial companies on the Nasdaq. Here we see the top 10 of those holdings. It has all the big boys in there, weighted by market capitalization. We love ETFs for their diversification and the fact that you only have to manage one investment rather than hundreds. But there are some problems that we should point out with buying the tech companies of the Nasdaq via this method.
Problem number one, not just tech. 46% of the fund is in information technology and 20% of the fund is in communications technology, making up just 66% of your investment in purely technology companies. We can see Pepsi in the top 10 holdings, not exactly a technology company.
And problem number two, weighting by capitalization. We want to invest in lots of technology companies to properly diversify ourselves across the tech sector, but all of the Nasdaq ETFs that we could find on UK platforms weight themselves by market capitalization. Consequently, 33% of the Nasdaq 100 ETF is made up of just 3 companies: Microsoft, Apple, and Amazon.
If any of these companies collapsed, then your investment would take a beating. We think it's better to have a more evenly spread portfolio of tech companies. An alternative way to invest in the top technology companies of the Nasdaq is to just carve out equal dollar amounts of each company for your portfolio by using fractional shares. Not as neat or automatic as using an ETF, but in our view it gives us a more diversified result in this instance.
Question of the day: is the world changing towards remote working? And are you buying tech companies? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.